Hello and welcome back to another video. Today we are talking about bond versus loan. Now before start the video, I will request you to subscribe my YouTube channel and press the bell icon for more latest videos. Difference between a bond and loan. The primary difference between bonds and loan is that bonds are the debt instruments issued by the company for raising the fund, which are highly tradable in the market, i.e., a person holding the bond can sell it in the market without waiting for its maturity, whereas the loan is an agreement between the two parties where one person borrows the money from another person, which are not tradable generally in the market. A bond is a loan used by large entities, corporations, or government to raise capital which they require for operating the business, and it's done by selling to the public. The terms bond and loan are related, however, they are not the same and have specific core difference. Both are debt. What is a loan? A loan is a debt in which a lender will lend the money and a borrower will borrow the money. A specific time limit will be set for the repayment of the debt money, including the interest amount and the principal amount the borrower has borrowed from that lender. This principal amount is mostly paid in installment regularly. Every installment will be called an annuity when it is a similar amount. What is bond? Bond is commonly referred to as the fixed income securities and is one of three major asset classes that individual investors are usually most familiar with, along with stocks, i.e., equities, and cash equivalents. Many government and corporate bonds are public traded. Others are traded only over the counter, i.e., OTC, or privately between the lender and the borrower. Critical differences between bond and loan. The main difference is that a bond is highly tradable. If you purchase a bond, there is usually a marketplace where you can trade it. It means you can sell the bond rather than wait for the 30 years. And in practice, people purchase bonds when they wish to increase their portfolio in that way. Loans tend to be agreements between borrowers and banks. Loans are generally non-tradable and the bank will be obligated to see out the entire terms of the loan. In the case of a repayment, bonds tend to be only repaid in full at the bond's maturity, e.g. 10, 20 or 30 years. Banks may expect the repayment of principal and interest during the repayment period at regular intervals. The USA and UK government bonds are perhaps treated as low risk. Interest rates on government bonds are generally lower. Private loans, on Unsecured debt, on the other hand, are likely to attract a high rate of interest. Corporate bonds are mostly somewhere in between, depending upon the reputation of the corporate. Issuing bonds giving the corporates greater freedom to operate as they deem fit because it frees them from the restriction often attached to the bank's loans. So friends, lot of thanks to watch my video. Thank you.